Hey everyone, welcome back to Corporate Decoder. This time we're diving into a document so twisty you'll think it's a reality show about corporate finance. It's all about Cactus Acquisition Corp. 1 Limited, a special purpose acquisition company also known as a SPAC, filing their annual report. Get ready because this story involves shifting sponsors, a struggle to find a business to buy, and a clock that's rapidly running out of time. This is their annual report, a Form 10K, and it's a deep dive into everything that's happened over the past year, so let's decode it. SPACs like Cactus are basically blank checks. They raise money with the promise to find a private company, merge with it, and take it public. But there's a catch. Cactus has a deadline. They need to find a company to buy before November 2025. Otherwise, they have to give the money back to their investors and shut down. This is what's referred to as the combination period. And talking about things changing, Cactus has seen quite a few changes in leadership. Their original sponsor, Cactus Healthcare Management, handed over the reins to EVGI Limited in February of 2024. Then just a few months later, EVGI passed the baton to the current sponsor, Artobion Inc. Ptl Limited, in May of 2024. It is like a game of hot potato. Despite the ticking clock, Cactus did manage to find a potential target. They signed an agreement to merge with Tembo ELV BV, which is a Dutch electric vehicle company, back in August. The price $838 million in Cactus shares. But their plans hit a snag. In November, Nasdaq, which is a major stock exchange, delisted Cactus because they didn't complete a deal in time. Now their stock trades over the counter, which generally means fewer investors and less liquidity. To buy themselves more time, Cactus held a shareholder vote in November and managed to extend their deadline to November 2025. However, this came at a cost. Some investors cashed out their shares, leaving less money in the pot for a potential Tembo deal. To keep the lights on, Cactus has been relying on loans. They've taken out a promissory note, which is just a fancy name for a loan, from Energy Holding Limited for up to $600,000 US. This loan is due next year, but if Cactus doesn't find a business to merge with, they might not have the cash to pay it back. AWM, the current sponsor, has its sights set on emerging technology companies, particularly in the renewable energy sector. They are looking at businesses involved in carbon reduction, hydrogen production, and other clean energy solutions. Now it's time to turn to the financial statements. These numbers tell a very concerning story about the financial health of this company. Their cash in the trust account, which is supposed to fund their big deal, has shrunk from $21 million US in 2023 to just $8.9 million US at the end of 2024, and the company now trades in the OTC market. Meanwhile, their debts, those pesky accrued expenses and other liabilities, remain high. This all results in a net loss of $1.3 million, while in 2023, at least they had some income. This is not a good trend. Okay, so now let's take a look at some risk factors. This part is extremely important for investors and what they should worry about. The ability to complete their initial deal depends heavily on the skills of their management team, and if they leave, the whole thing could fall apart. There is also risk that there may be conflicts of interest that influence their decisions. This next risk is a big one too. If too many shareholders decide to cash out before the deal closes, Cactus might not have enough money to complete the merger with Tembo. We now come to what might be a make or break aspect. They only have until November 2025 to complete the deal, or the entire business combination with Tembo will fail. So that gives a lot of leverage to the deal. And we finally get to the last key thing, which is, as mentioned before and has been mentioned in the note, is substantial doubt about their ability to continue as a going concern and operate normally without further infusions of outside capital. That's what the filing is about. So what's the story and what's the overall take of this filing suit? Well, let's start with leadership. There's been a revolving door of sponsors, and now this company needs to complete the business combination, but the financial statements don't paint a rosy picture. The cash reserves in the trust account are rapidly dwindling, and reliance on debt financing is increasing. So if Tembo deal falls through, it could leave them with very few options and not enough funds. The company also runs the risk of redemptions by investors. However, there are many opportunities. The current management has sector experience. There's also that large $838 million valuation if they can actually reach that business combination. However, there are many risks, and it is not sure if they will even be able to reach that point given their issues. The next several months will be crucial in determining their fate. Crying overall, it is a speculative bet. Thanks for tuning in. If you found this corporate decoder video helpful, please subscribe and give us a like, and as always, do your own research before making any investment decisions.